In an earlier conversation focused on Jeremy Weinstein's Inside Rebellion book, we made the observation that the resource endowments that groups begin with, whether they're social endowments or material endowments, basically loot, has a huge impact in terms of how groups evolve. Likewise, Collier made the observation that states that were commodity dependent tend to be more prone to civil war. And so I'd like to kind of dig into both of those themes today and in a subsequent conversation to try to understand how the sort of material resource environment that states and rebels operate in maybe shapes how they behave and their prospects for rebellion and ongoing rebellion. And so we'll just begin with an observation of a correlation that Collier and others have documented, that poverty and civil war, or poverty and rebellion, tend to be correlated. We could say that these are risk factors for rebellion, but again, consistent with a sort of our risk factor idea of civil war happens where civil war can happen, and therefore things that make it easier to have a civil war are maybe worth understanding more so than just abstract poverty is dangerous. So when we're trying to understand what about poverty and low-income countries makes them prone to civil war, some folks have keyed in on the low levels of education that oftentimes are found. This is something that Clayton Thine has argued for, that education is a strategy for reducing the likelihood of civil war violence. Oftentimes, poor countries tend to have a younger population, and as Collier and others have shown, a younger male population tends to be a risk factor. That tends to be the cohort that's most easily able to participate in rebellion, and therefore, again, the opportunity grows. And then maybe we want to make a case of opportunity costs, that there are fewer economic opportunities in very poor states, and that maybe reduces the barrier that might prevent somebody from throwing away sort of the trajectory of their life to join a rebel movement and try to overthrow the state. So we could talk about how poverty itself has a lot of risk factors, but one of those other things that kind of correlates with that is commodity production. And as Collier notes, poor states tend to produce a lot of commodities, tend to have commodity-reliant economies, but commodities seem to matter above and beyond just the level of wealth of a country, that regardless of whether you're wealthy or poor, relying heavily upon commodities is really bad for the stability of the state. And so we could talk about this in a couple different ways, and we'll do a case study talking about oil as a possible way that this could work, where state capacity could be vulnerable, that if you are heavily reliant upon commodities, normally you're able to generate revenue for the state and to pay for the security forces and buy off potential adversaries. And as long as commodity prices are good, that's all well and fine. But when commodity prices drop, suddenly you're facing an economic shock, and that may be very difficult. Alternatively, you can make a case that commodity production creates opportunities for rebel groups to benefit from that commodity and that commodity extraction. And so we've seen cases in, I think, Cambodia, where rebels relied upon the timber industry. They basically just cut down trees and shipped them out of the country and were able to finance their operations that way by the export of just basic commodities. That tends to be less common. And in fact, when we look in, although we do have examples, but when we look into how commodities affect the duration of civil wars, what we find is that high commodity production, while it does increase the likelihood that you'll find yourself in a civil war, doesn't seem to extend those wars. They don't last longer when there's a lot of commodities involved. And this is important because Collier makes this sort of distinction between greed or grievance, that some civil wars might be motivated by, dissatisfaction with the government and genuine grievances. In theory, those kind of civil wars should be negotiable. They should be easily resolved by addressing those grievances. By contrast, some civil wars are motivated by greed, that there are economic opportunities that come with war. And when we talk about lootable resources like drugs, things that are very high value that might not exist when there's not war going on, or might not exist as an economic opportunity, those type of resources tend to prolong conflicts, and those kind of conflicts tend to be essentially, we think, extended by greed and the desire to continue benefiting from that conflict rather than seeking some sort of redress for grievances. Okay, so that's a little bit of a tangent on commodities. I'm going to circle back to why commodities are more important above and beyond just a momentary disruption of state capacity. But I want to quickly highlight a fairly prominent commodity that gets a lot of attention in the literature, specifically oil production, and there's been a observation that countries that have oil wealth tend to be more aggressive, and countries that have oil wealth tend to be more unstable. And I think you can make a case that control of oil revenue provides a source of grievance. In the case of Sudan, there was a sense of there was this oil being extracted from the south of Sudan, or could be extracted from the south of Sudan, but would it be extracted by the north? And potentially there would be an issue with revenue sharing, and how would that work? And that was maybe a kernel at the core of the Civil War. Who gets to control that revenue? A number of years ago, I saw a survey about support for a separate Scottish state. And support for that independence for Scotland tracked almost perfectly with the price of oil. And the thinking was there's this oil in the North Sea that potentially could benefit Scotland. And when that seems like a very lucrative resource, people in Scotland seem more inclined to support secession than they would when oil isn't as desirable of a thing. But what we don't see is rebel groups financing their rebellion with oil. It is a commodity. It's sold in international markets, and while in Cambodia rebels were able to sort of throw timber at smuggling operations and get it out, we don't see that happening with oil. And part of that is that oil requires foreign investment, and on a fairly large scale, and foreign technology to be able to extract in any sort of reliable way. And as a result, it really only tends to benefit the government. That the government, which has sort of the legal claim to that oil, is able to work with multinational corporations and to get that construction and that investment that can potentially exploit that resource. Rebel groups just simply don't have that ability. It's very hard to get oil companies to invest when there's not clear property control and legal rights associated with that. This is something that was at play in Iraq, that the Kurdish sort of independent government in the north was trying to get international companies to invest in oil production in the Kurdish north of Iraq, but it was unclear how the revenue sharing was going to work between sort of the Kurdish north and the rest of Iraq, and multinational corporations were hesitant to step in until those questions were resolved. On the other hand, oil potentially functions as an easy target for disruption, that rebels could blow up pipelines or target oil infrastructure, and that can have a huge effect on the ability of the government to rely upon that resource and to use that resource and extract money from that resource, which potentially weakens the government. Also, ongoing reliance upon multinational corporations and international support for oil extraction and production means that if a situation becomes dangerous, if a state becomes overly repressive, there may not be that international investment. And so what we're seeing here is a couple things. We're seeing that how much a commodity matters is a function of kind of how it's produced, how much capital it goes into that production, who controls that capital and can sort of make decisions about what's produced and when and where, and that can pose a different set of problems for the government versus rebel groups. And so the takeaway from our little case study here is that not all commodities are the same, and we're going to have to drill into this a little bit more in depth in a subsequent conversation to understand why some commodities contribute to civil wars and others don't. But before we get there, I want to talk a little bit more about why we think commodities are so bad. So we've talked about sort of that vulnerability of disruption, but I'd say that there are probably secondary effects that go along with heavy reliance upon commodities, particularly high-value commodities like oil. And so one of those things is political decline. That if you are able as a state to extract revenue and finance your operations by taxing something like oil at the border as it leaves as an export, then your incentives to build up a tax base, in fact, your incentives to tax your population at all, essentially evaporate. And if you're not engaging in taxation, you're not forming a state infrastructure that's able to reach out into the population. You're not able to form the kind of ties between the population and the state that says, you've taken this money from me, I expect services in return. Instead, all money flows from the state, and there's maybe not the sense of legitimacy around the government that gets built in a system in which taxation requires some level of consent and engagement from the population. And so what we see is that states that rely heavily upon commodities, particularly high-value commodities like oil, tend to not build state capacity in the same kind of way as states that have to actually engage with their population and maybe make a trade of public goods for tax revenue. The second thing that goes wrong when you have an economy highly dependent upon commodities is that you're exporting all of these commodities and money is flowing into your economy to pay for that. And what that does is it raises the value of your currency. Because you're exporting so much, because money is coming in, the value of your currency goes up, which means that other exports that you might want to sell on international markets start looking really expensive. This is called the Dutch disease, where I think in the 50s or 60s, the Netherlands had a natural gas boom, and it ended up crushing the Dutch manufacturing sector, because as the price of your current, or as the exchange rate on your currency rises relative to other currencies, your export sector starts becoming uncompetitive, not because it's doing anything different or not because it is uncompetitive, but because in terms of currency, it looks uncompetitive. And so what we see is in economies that extract commodities and export those commodities in large quantities and for large dollar values, it essentially strangles the rest of the economy and inhibits manufacturing growth, inhibits export growth, and essentially prevents the emergence of a middle class, or in the case where a middle class already exists, it has a detrimental effect on that middle class. And so there's maybe an economic component to commodity reliance that maybe inhibits economic development, which might counter poverty. It inhibits economic development, which might provide the foundation for, public education and literacy rates to go up. And so all these things end up tying together, but commodities end up being very dangerous and toxic as a primary source of revenue for a variety of reasons, both in the short term with that vulnerability piece, but also in the long term in terms of the economic and social and political consequences of reliance upon commodities.